My name is Owen Rask, and I'm pleased to bring to you the first of a four-part series in which we're going to be looking at different companies each and every week. And we dive deep into them as part of our Tiger Stocks series. In collaboration with Tiger Brokers Australia, we're going to be looking at some of the most popular companies in the country. And by that, I mean companies that people are actively buying and selling across the Tiger platform, but also just generally. And we're going to, as part of this, do a bit of a giveaway. So I'll quickly flick on my screen before I get stuck into it. So all of the live shows will be available on replay, just on the Rask YouTube channel, as per usual. And you can watch back at any time you like. Every week, we'll be doing a giveaway. And as part of the promotion between Rask and Tiger, there will be some special offers up for grabs. For example, if you join using the link, which I will promptly paste into the chat, give me 1 second, you will be able to go in the draw to win a prize if you fund your account. And I'll just get this up now. It will be in just a second. There we go. And you also, just in addition for funding your account and trading, you also get some fractional shares and things like this, which you can see on the screen in front of you right here. So that is now in the chat. If you do want to grab yourself a Tiger account, please go ahead and do it. I'm very thrilled to be able to do this because it means that you benefit from just taking part in the live series. So over the next 4 weeks, we're going to be covering a few different companies. And as always, we're going to be talking about finance and investing. So it's really important that you remember that any of the information that we deliver today is general in nature. I don't know your personal circumstances, so it's really important that you remember, I don't know if you do want to, be a professional investor. I don't know if you are interested in dividend stocks. I simply don't know. And so for that reason, you would have to speak to a financial planner before you act on the information that is delivered in these short videos. If you do want more information on the Rask Group, you can head to the Rask website /FSG and get a hold of the information that tells you exactly what we do and how we do it at Rask. You can also find information on how to find a financial planner on the Rask websites. So as part of this four-part series, we're going to be we're going to be toggling between Aussie and US companies. So in the first week, i.e. today, we're going to be talking about Pilbara, Qantas, BHP, and Flight Centre. And then next week, we're going to switch gears to the USA. We're going to be looking at some of the titans of the US consumer. And we're going to be looking at Costco, Apple, Microsoft, and Tesla. In week 3, that's 2 Thursdays from now, we're going to be looking at some of the most popular companies in Australia, based not just on trades, but also from recent price performance. And that we've got WiseTech, Altium, ARB, and NAB as a bank there. So that'll be a bit of a different mix. And finally, we'll finish off in style with the US market again, where we'll look at some of the most popular or trending stocks, if you like, in the United States, being all of these businesses that are playing into things like AI, automation, big data, these types of things. So Amazon, Nvidia, Google, and Trade Desk, which is that logo there. You probably may not have seen that one before, but it's incredibly impressive business. So over the next 4 weeks, we'll be focusing on 4 companies every week. I'll be looking at company fundamentals, the industry opportunity in front of those businesses, of course, long-term investing only, leading consumer brands. Like you can see here, this is a photo from inside the Perth warehouse of Costco. So this is here in Australia, and it was taken from Wikipedia, by the way. But we'll be focusing on, like, why do consumers go and pay for a Costco membership when they could go to Aldi, when they could go somewhere else? So we'll be looking at all of that, and we're basically trying to identify long-term compounders. Some of the companies are already doing that. Indeed, one of them is today, which is really impressive. One of the companies today is really impressive. And obviously Tesla, many people will know how fast it has grown in recent years. So we'll be focusing on these types of businesses. And to do that, what we'll be doing is we'll be using some company data, some fundamentals. We'll be looking at annual reports and industry reports. I'm going to show you how to research a business from scratch. And of course, you're more than welcome to put comments in the chat if you're watching live, or you can put comments after the fact, and then I can incorporate them next week. Just a reminder, though, if you do want to be part of the giveaway, you will need to fill in an account and fund that account here, and then you get automatically selected, and hopefully I can announce it next week. We have had quite a few people do it already, um, but to be honest, I think the chances of getting some cash is pretty good. And if that fails, then the other alternative is you end up getting some fractional shares. So it's pretty good. It's free to create an account on Tiger. Okay, so we're going to be scoring these companies, and I'll explain that in a little minute what that means, based on company fundamentals. And at the end of the 4 weeks, we'll be able to look back and see which companies score the best, depending on what we want to do. So what I might do is I might actually quickly change colors for for 8 of these companies, because just to differentiate between US and Australian, because what you find when you do a checklist is if you had an investment checklist of US companies, they tend to rate much higher. Like if you're comparing, for example, Apple versus even BHP, you'll find that Apple's financials are much better. So you'll give it a higher score, but that does not necessarily mean that it's apples to apples comparison. So once again, chuck your comments in the chat. Let me know how you're going today, and I'll begin cracking on with this. Before I do, there was one feature that I wanted to call out from Tiger. Um, Many of you will know I'm a huge fan of automating your investing, long-term investing. It works because it's simple, it's low cost, and it's repeatable. Um, and one of the features that you can do on the Tiger app, which I've got here in front of me, I couldn't actually share my screen into the live stream today, so I might figure that out before then. But this kind of shows you on the screen right here in front of you. I'm about to show you the desktop version, but this is the mobile version here. And you can see you can literally just pick your investment, whatever you want to invest in, whether it's VAS, an ETF, or Tesla shares, or whatever. You pick the amount you want to invest, how often you want to invest it, and you just submit it. And that's as simple as it is. And you can cancel it, you can do whatever you want. And it's just about auto investing into different investments over time. So say if you have an investment that you want to make every month, it's pretty simple. I think it's a pretty cool feature. So that's why I call it out. Okay, so let's get into it. And in order, I wanted to start with Pilbara Minerals, which is this business here. PLS is the ticker symbol. And I'm going to be chopping and changing, and I apologize in advance between my slides here and the screen that I've got here to show you these types of things, and the desktop app, which I'll quickly show you from Tiger right now. So I'll just bring this up. Here we go. So there it is. Wonderful. Okay, so one of the things you'll notice when you log in, obviously there's a lot going on the Tiger dashboard. So you'll see this is just a company chart. You'll see all the different companies down the side here. I made a few changes to this. When I loaded it, it had a lot of like stock trading material in here. Obviously, I'm not a stock trader, so it's not really that relevant for me. So I remove those just with the features at the top here. But down the right-hand side, we can also see things like company filings. So I could just click on this, opens in a new tab. You can see news, and this is pulled in from like the Motley Fool, Reuters, Simply Wall Street, Livewire. All of that stuff is automatically pulled in here for you. You can get a quick take on the financials here. And one of the things that's really cool is this segment level financials. So you don't just get like revenue at the top, you also get to know where the different things come from. I'm just going to quickly jump across to the first company, which is Pilbara, and we'll get this up here. And one of the things I want to get to in a moment with Pilbara is I want to get to things like this, which is the return on capital. And you can see all of the things in this chart here. There's a full financials tab, which I'll open in a moment. But you can see all of the financials are moving in the right direction for Pilbara, and it's pretty easy to see why, and I'll explain in just a moment. But you can see revenue is just literally taking flight. So it's hit what we call an inflection point. And throughout this series, I'll assume you know kind of some of the lingo in investing, things like inflection point. But basically, Pilbara's reached a point where it's literally just taken off, in fact. And I'm going to bring up a different tab right now, because when I click this materials tab at the top here, it actually opens up in a different tab. So just give me a second. I'm just going to bring that one up here as well to show you what it looks like before we crack on. So it looks something like this when you get in and you click on it. You can actually get a summary of the company. You can see all of the financial information. You see who are the key shareholders in the business. You can see the segment level financials, which is what I was talking about before. Now with Pilbara, it actually only has one division. It just mines lithium. And you can see all of that here. You can see where it makes its money, etc. But if we go down to the financial section, We can see what I wanted to see, which is revenue taking off. We can see the balance sheet, so we can see the cash is predominantly what you see here in these assets. You can see cash flow, pardon me, and you can see other types of things down the bottom. But the one that I wanted to call out over on the financial analysis tab, for all of the companies we'll be looking at, the metric that I want you to look at is this metric right here, return on capital, otherwise known as ROIC, return on invested capital. And basically what it does is it compares the internal generation, of the internal returns of a company. So what I mean by that is, like, imagine the company has $100 million of cash in on its balance sheet. It wants to reinvest that into its business, and next year it's got 130%. Basically, that means that the return on capital is about 30% because you're getting a 30% return on your capital. Now, the reason this company has gone from negative to positive is because it's obviously had not even a profit while it was building out its mining in Western Australia. And then all of a sudden, it's got this huge inflection point where it's all of a sudden moved to profitability. Revenue has taken off, it's lifted profits, and we can see return on capital is a 74%, which is just unbelievable. The reason why this is unbelievable, and it probably won't be sustained if I'm honest, but the reason why this is unbelievable is because if you can find a company that has a return on capital, let's say of 50%, and it could get a bank loan from, say, CBA or NAB or one of the big banks, if it could get a loan for 10% interest, you would think that in just if you just took those 2 metrics alone, you would just get the biggest loan you possibly can, so that then you can take that money and you can invest it in your projects for a 50% return, pay your 10% interest, and you're still left with 40%, and you can just keep repeating that process again and again and again. And that's what we call a competitive advantage. When a business can create a return on invested capital above the cost to get that capital, so if it's a debt, a loan in this case, that is the beauty of a competitive advantage, and only a few companies are able to do that in the world. But some of them, if they strike literal gold, whether it's in this case a mining company or some of the other businesses we'll talk about in a couple of weeks, like Google search, you can actually do that, and it can defy the laws of finance and defy the laws of economics, because those businesses can sustain those returns for longer periods than you expect, and that ultimately means that the companies grow more and more and more profitable over time. And that's what we can see if we go to the income statement for Pilbara, reading from right to left here. You can see the company's gone from $42 million revenue over here to $4 billion. I was reading some research before from Macquarie, actually, and they think that revenue will probably stabilize this year, maybe slightly higher, and then next year hit 6 billion and continue to go up and up and up and up from there. Mind you, keep in mind Macquarie and some of the other analysts were actually wrong on a lot of their research. They underestimated the company. Um, and so the business just keeps flying higher, and you can see that here, total revenues. You can see the operating income, which is how you calculate ROIC, by the way. You can see that it's gone from negative to positive in a big way, and that's what's enabled the profit margins and everything to go higher with it. One of the cool things here, you can just toggle to year-on-year growth, and you can see the year-on-year growth in revenue. Now, one of the things, I actually calculated the 3-year compounded annual return for Pilbara's revenue, and I think it's compounded its revenue at 187% per annum. So over 3 years, it's compounded at 187% per annum, and that's because its mining and production has hit that inflection point where it has just rocketed off. Lithium prices have gone up, and that's brought up its revenue in recent years, as well as production. And it's only been in the last year where lithium prices have struggled. So I'll bring that up now on our screen. So just it's just a way to show you how you can do fundamental research pretty quickly. You can also get the actual statements and the actual filings here, and it just connects you straight from Tiger to the ASX website. So that's that. I'm going to just bring up this other slide really quickly. Go over here like this. Okay. So why don't we actually just give Pilbara, in the interest of time, why don't we give Pilbara an indicative score for this first thing at the top here, which is growing sales opportunity. And so Pilbara's selling lithium, spodumene, into the global market, and it sells it at a good price. There's been some recent weakness in the prices of lithium, but lithium is a major component of batteries, right, which is the future of electricity and sustainability from a carbon perspective. Actually, one of the Rask analysts is in China this week, and he was saying to me that he's been blown away by the number of electric cars in China. He said, and it's based on some of the data that I've seen, that as many as 25% of the cars would be electric, which is incredible. A lot of BYDs and these types of other businesses are creating these cars in China. But even Tesla, who we'll talk about next week, has a huge presence in the Chinese EV market. And what we can see is this, even though we see fluctuations in the price of lithium, a long-term structural thematic is that we will need more lithium, we will need more copper, we will need more nickel, and these types of things to basically live the life that we want to live in the future with a carbon footprint that is declining. So even though lithium prices have fallen, the reality is that it's producing more than ever before. So for the most part, for Pilbara, it's actually a pretty positive outlook, and I don't normally say that about commodities businesses, but it is definitely the exception to the general rule that most commodities businesses really do struggle from one year to the next. It has hit scale, it is still ramping up production, and it has a huge amount of cash on its balance sheet. So for the most part, I wouldn't say it's a defensive business model, but I wouldn't say it's a terrible business model. So out of 10, I'm gonna give it a 5. And for the sales opportunity, I'm actually gonna give it maybe like an 8. Now, if you agree or disagree, jump into the chat and let me know. You can do that anytime, just on YouTube, just let me know. Um, is it a business you can understand? Well, it's pretty straightforward, to be honest. Even though it's on the commodity side of town, which I don't normally invest in, and to be honest, I don't hold shares in any of these companies we're talking about today. But for Pilbara, it's a pretty simple business. It has, basically 2 facilities, 1 big mine. It pulls stuff out of the ground. It sells it into the global market. There's a fair bit of, I guess, uncertainty around customers and geopolitical risk, like selling into China, for example, has been a big geopolitical risk for Australian businesses in recent times. Um, but for the most part, it's selling more. It's also um, producing more, and it's got really high quality product. So you can see it here in terms of the resources grade they've got with the major project, and they're bringing more of the facility online. So I think for a lot of folks that are thinking about lithium exposure, it's definitely one that a lot of people would go, well, for high quality. It's in a developed market like Australia. It's got good infrastructure around it. Management seems to be aligned. It's a good business to put in your more speculative side of the portfolio. I'll get to that in a minute. But I think it's a business that most people can understand. So I'll give it a 7. It's probably not like a Woolworths though, so maybe we'll give it a 6. It's not like a Woolworths where you can just understand it's a supermarket, it does what it does, or like a Costco. Um, so before we get to the management section, I did want to highlight a few slides here. The first is this, that a lot of these companies like Pilbara, for example, is the type of business that you would put in a satellite position of a portfolio, not in the core of a portfolio, at least not in my opinion. In the core of a portfolio, you want low-cost ETFs, you want maybe even some managed funds. Maybe if you think about it this way, I don't necessarily think about it this way, but if you had investment properties or property, you might put that in there somewhere. I don't really think about it. I kind of think of property separate to what goes into the core of a portfolio. I kind of think about that as a separate stream. But for the most part, these types of companies like Pilbara, which is highly volatile, share price kind of bounces around all over the place, year-to-year results are basically dependent on commodity prices. You've kind of put them around the outside in smaller positions. Um, so don't forget, as we go through the series, the core and satellite approach to investing is what I follow, and it's basically what all of the Rask community follow as well. And so once again, we're going to be covering different companies in coming weeks. But the 4 that we've got today is Pilbara, BHP, Qantas, and Flight Centre. I think I know a bit about these companies, obviously already just doing a bit of research, but what I would say is Pilbara seems to be the most laden with potential. It definitely seems to be the business that has, I guess, the most scope to continue growing long into the future. So let's have a look at the management team, and I'm going to bring up the slide again. I can't share 2 windows at once with my software, which makes it a bit hard, but we're going to bring up this one. I think it is. I'm going to look at the shareholder section, and here we can see the types of owners of the business. So we can see how many like insiders own it versus other people. See the number of shareholders. We can see the number of institutions that are holding the company. We can see who owns the shares here down the left-hand side, and we can see a lot of institutions here holding the shares, whether on their own behalf or on behalf of other investors. State Street, BlackRock, Vanguard, Australian Super, JP Morgan, you can see all of these massive institutions owning a lot of stock. But if we wanted to find out more about the management team, how do we? Oh, sorry, I'm not showing my screen. Here we go. Here inside Tiger, we can see who owns the shares, how many shareholders they have, and the types of institutions that are, I guess, involved in the business, how much of a percentage of the company they own. But how about if we wanted to find out about individuals? Let's go back to our slide from before. Bring this up here. And let's just jump into the annual report. For Australian companies, it's really easy to find out how much a director owns of the shares they have in the business. So if we go just search for remuneration report, and we go down to where we've got key stakeholders owning shares in the business. Bring this up. So I keep pressing enter until I get down to a table that I'm trying to find. Now, this isn't an exhaustive way to do it, but it basically just shows you what's involved, who gets paid what, how do they get paid. If you've got more time, you would want to go through all of this and look at the blend between short-term incentives and long-term incentives, and you would want to see more long-term incentives. Long-term investors, you want the company and the key people that are making decisions in that business to, I guess, live up to the expectation that they're creating long-term value. They're not just going after their short-term rewards. So I'm going to keep going down. I'm going to find this table. So here we can see a blend between the different types of remuneration they're getting. You can see the CEO, Dale Henderson, 1.25 million. You can see the other, I guess, key management personnel, but this is the table that I wanted to start to look at. So we can see a summary here. We've got a salary of $1.37 million. We can see variable components, so we can see short-term incentives, 883,000. Performance shares, so this is based on them earning it, of 1.8 million. So we can see a skew towards longer-term incentives, which is this one here, and not as much in short-term, but still quite a big component of short-term. But you would expect that, given that the company has performed so well in the short term. So I'm going to finally look at something else to show you this. Oh, you can't see the table. Sorry, Chris. I keep doing this because I keep toggling between tables. Okay, so here we can go. Sorry, mate. So here we can see on the table in front of us, we can see the CEO's REM. So here we can see $1.37 million of salary. We can see the 1.8 million in performance fees that I was suggesting before, and the short-term incentives. So just based on this table alone, we can see in this section right here, we can see that there's a skew to longer-term incentives, which is what we want, even though they've made a lot of their money from short-term incentives, which you would. It's okay because the company has performed so well. You would expect them to earn something in the short term. You can still see that there's a long-term incentive there. Now I'm going to try and find the final table. Da, 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 No. Okay. There's one more table I'm trying to find. Here we go. So this basically shows us what management are doing with their shares that they own in the business. So here we can see that Dale Henderson, at the beginning of the financial year, had 526,000 shares. At the end, had 1.2 million. Now, if the share price is, let's have a quick look. If the share price is $3.62, it means that he's getting, probably about $4 or $5 million of stock at the end of the year. So let's go back to about $4 or $5 million of stock at the end of the year, compared to his salary of 3.8 million. That basically suggests that a year's worth of his stock of his salary is basically tied up in stock. So it's good long-term incentives, but it's probably not the most that I've ever seen. So it's not actually a great sign for me. I'd like to see more long-term incentives. Another thing that we could do if we had more time would be to look through things like tenure and try and find out things like how long have you been with the business, what's your track record at other places, these types of things. And so I would like to see slightly more there, but I'm just going to say it's pretty good. Maybe I'll go 2.5, give it a half score there. Finally, two more things because I'm running out of time and I'm spending a lot of time on Pilbara, probably because it's the best one of the four. Um, I actually think like strong profit and cash flow is probably the most important thing for any business that is a resources business because it gives you firepower um, when commodity prices inevitably fall. And many of you know how to get to cash flow, but we've obviously got the profit and loss statement or income statement. We can see revenue is growing dramatically, gross profit is growing, and all of the things, more and more of the sales that are inside the business are falling to the bottom line. So we can see more and more of that just dripping straight down the income statement, and more of it's falling to net profit. And that's because the mines have moved into production. They don't need to keep spending. They can still just keep them operating and they will make more and more money. Coming down, you can see that they're starting to accrue huge amounts of cash on the balance sheet. I remember when I first looked at the business a couple of years ago and I thought, wow, how did it get so much cash inside its business? Well, that's even just more dramatic now. You can see it's got a lot of property, plant, and equipment, about $1.3 billion, which you'd expect for a mining company. It needs a lot of equipment, a lot of like trucks, a lot of conveyor belts, these types of things, all the things you can imagine. And if we drop down, we're looking at cash flow. So we can see strong cash flow from operations here. We can see they're spending a bit in terms of property, plant, and equipment that they need to do, mine upgrades, these types of things. And they recently installed a new rejection machine, which basically means that they can, sort more of the fill that's coming out of the ground, and they can get a higher grade product being shipped each and every week, and that is capable of 100,000 tons per annum, I believe. So all in all, they're investing reasonable amounts, but you can see that their cash flow is growing so much faster than the amounts that they're reinvesting back in the business. And this is the thing about these types of businesses, about a business that is in a resources kind of boom, is they're going to be there for a good time, not a long time, because eventually the businesses get to a point where they can't really keep sustaining these levels of growth, and competitors emerge, and the market becomes saturated with more product. And so while the going is good, you want them to make as much profit as possible and do something sensible with it. If you go back about 10 years, there's probably another example of a business. Um, Let me just bring this up. There's probably another example of a business, not in lithium, but in gold, which were Northern Star Resources. Now, Northern Star Resources kind of came out of nowhere. It was kind of this company that just emerged, started buying up some key gold mining tenements, and was able to optimize those tenements and create huge amounts of cash flow for the business. And you can see, I remember covering the company at 85, 90 cents, I think it was at the time. 2013 got up to a high of $15. Lots of cash generation, and that's what we want to see. And Pilbara is probably on that similar trajectory, to be honest, but probably will be more volatile. So this is a really good sign. I'll give it a 9, to be honest. I probably could even give it a 10. I haven't seen many companies sustain that level of cash flow growth and so rapidly. So is the company reasonably priced? And at the end of the day, we won't go into a full valuation here, just in the interest of time. But at the end of the day, the company has a high return on invested capital. I keep switching to the wrong one. Has a high return on invested capital, is growing its revenue extremely fast, has a pretty solid runway for growth, has a huge cash balance. And for the most part, it's probably, if it can sustain the growth, then it's not super overvalued, but it needs to sustain that growth in the face of potentially falling lithium prices, which is the key uncertainty. So I'm gonna give it a 3 or a 4, um, and say there's no negative override for this business, but there will be for another company in just a second. So overall, 34.5 out of 50, which is not a bad score for any type of business, to be honest, on our very simple, quick checklist. Now, of course, we wouldn't just go and buy the shares based on this checklist, but it gives us a sense of, well, now that we've done a quick run through and we do another one for BHP, another one for Flight Centre, another one for Qantas, then we can go back and we can say, hey, well, maybe we want to spend more time on Pilbara rather than focusing our research efforts on Flight Centre. So that's probably the key distinction. We're not trying to use this to buy shares. We're just trying to use it as a research tool together with obviously Tiger in this instance, giving us a summary of the information and going into the financials. So I might actually jump to Flight Centre because there's something interesting that I wanted to show you. I'm just going to get out of some of these ad reports so I don't get too confused myself. Just a reminder though, you can create a free account and go in the draw to win. You'll find more information on the Rask website as well. So one of the businesses that is on our list right now is Flight Centre. And if you're in the chat and you want to comment, I would love to know if you've booked anything through Flight Centre recently, or if indeed you've booked anything through Qantas. If you've booked travel, airfares, these types of things, let me know. I was actually going to do a survey if I had more time today, but I didn't get around to it to see how many people in my circles would actually book on Flight Centre versus, say, Qantas. For example, at Rask, all of our booking now goes through booking.com, which is the big global player. And if it doesn't go through booking.com, it actually goes through the Virgin Australia website directly. Because we only fly with Virgin at Rask, it's easy to maintain all of that and go direct. The reason I bring this up is because a lot of people look at Flight Centre. It is one of the world's biggest bricks and mortar travel agents. So you can go down to your local Flight Centre store. Let's bring up Flight Centre in Melbourne, maybe, which is my home city, and we can see that there are a few Flight Centres in and around town. Wait for this to come up, and we can see this Flight Centres basically everywhere. These are physical stores you can go in to book your travel, right? But what's happened in recent times is we've seen a rise of people, I guess, booking their own travel and going direct. For about the past 10 to 15 years, more and more people have decided, well, hey, I can kind of book it online myself. I can use the app. I'm pretty tech savvy and, all that sort of stuff. And for people that are really young, they're probably thinking, what do you mean? Like, do you need to go into a travel agent? These types of things. A lot of people still do. I'm not too ashamed to say that I'm in my early 30s and I still like to go into a store occasionally if I'm booking overseas travel because it makes more sense to get people with expertise and people who can package it all up and just deal with the complexity of trying to book multiple destinations overseas and do all that. And Flight Centre has increasingly moved into doing that for corporate customers as well. So, say, for example, your BHP, which we'll cover in a moment, and you need to book travel for your company and for your thousands of employees to do each and every piece of travel every week. You could use Flight Centre's corporate arm to do that, and they will manage all of that for you. You went to Bali this year, Chris, or you've got Bali this year. That's great, mate. And I'm guessing you could probably do that through Flight Centre only. You can book flights and accommodation through Flight Centre. But one of the things that I was reading is I like to jump on the Morningstar website every now and again and look at what their analysts say. I think the analysts are great at what they do. And one of the things that Morningstar actually said, without giving away too much of their secret sauce, one of the things they actually said was that they think that Flight Centre has no competitive advantage. And one of the reasons for that is there's a big shift in the industry of people trying to book their accommodation directly rather than going through like a Flight Centre travel agent. So a lot of people can go to the Flight Centre website. And I wanted to test this theory that the Morningstar analysts have. I wanted to test whether they were actually correct. And one of their, I guess, opinions was that a lot of younger people won't be using Flight Centre. They would go to the website directly, they'd book online, et cetera, et cetera. And I wanted to test if you could, basically just figure out how to do that, figure out if people are actually doing it online or not. And one of the things you can do if you're researching online businesses, and this is the tip, I guess one of the master tips for today's installment of Tiger Stocks, is you can actually go to similarweb.com. Now, I've just got a free trial account here, there's a 6-day free trial left, and you can actually go on the website, and even though it's still limited, it's only a free trial, it will actually show you how many people are engaging with particular websites. And so here you can see I've done a comparison of flightcentre.com.au, Webjet, and What If. And I've just done that for 1 month, and I've only got the worldwide statistics, not the Australian ones. You have to pay for an account. Pretty expensive old SimilarWeb if you go down that path. But anyone can use the free version of SimilarWeb or get a free trial. And what you can see here is the analytics for the website. So you can see for things like monthly visits, unique visitors, Flight Centre is actually bigger than Webjet. Webjet's my third option, and many of you will know that Webjet it's only online, and it only does, booking for online travel through the website. You can call them and those types of things, but it is an online service, whereas Flight Centre combines that with in person. And so Flight Centre, I guess what I'm trying to get at here is Flight Centre does have a pretty strong online presence. Even though people associate it with bricks and mortar, it does have a pretty strong online presence. And it's not just an Australian business. With over 1,000 Flight Centre offices around the world, UK, USA, etc., it's actually one of the five biggest flight travel agents in the world. There are some bigger ones, like American Express is a bigger one, for example. But for the most part, Flight Centre is actually a major business globally, headquartered in Brisbane, of course, but a major business globally. But if we just look at the Australian websites, and so we can see .com.au for Webjet as well, what we can see here is that around 3.3 million monthly visits, and they get around 1.7 unique million monthly visitors, which is still bigger than both What If and Webjet. The thing is, it's not bigger than things like Virgin. If you were to compare it to Virgin Australia, something like this, or go Jetstar, another big airline. Yeah, so now we've got the websites. So here we can see that Virgin is the biggest of all of them. I think I'm supposed to do jetstar.com, not Jetstar. There we go. The problem is when you go to .com websites, you get traffic from other websites as well. Um, So here we can see Virgin has about 4.6 million monthly visits for 1.9 million unique visitors. Jetstar is a far, far bigger website, and that's because a lot of the booking goes through these two websites. Whereas when you go to Flight Centre, Webjet, or What If, you're mainly doing it for booking, not for ongoing checking of if your flight's delayed or things like this. A lot of these businesses also have apps that allow you to book as well, so you don't have to go to the website. But in any case, this is a fantastic tool to see, do these websites actually get traffic? Where are they coming from? And so on and so forth. But the thing that I really wanted to test was the demographics. How old are the people that tend to use these websites? And the thing that I wanted to show you, if I can find it, I see it before. I do come on this website a bit, but not all the time. And I want to try and find out. I think it's let's just go straight to demographics. So if we go down to, I'll just bring up Flight Centre because they're all quite similar. But the thing that I found really interesting about the people that visit the Flight Centre website, contrary to what maybe the analysts were saying, that it's maybe not gonna be younger people, it actually is younger people who are the most likely to visit the website. And I think one of the reasons for that is that a lot of younger people tend to be traveling, um, and when through the middle of your working life, it tends to fall off a bit. But you can see a lot of people are using the online version of Flight Centre, and it remains relevant. That's probably the key thing, it remains relevant. So even amongst the younger audience, they're using it. And in fact, the older demographics skew to the online-only options. So it's quite interesting, I found that a lot of people would assume that flight centers are, it's mainly bricks and mortar, older people's type of brand. It's actually younger people using it as well. Now, if we go to some more of the financials, because I've got to be quick, I keep getting brought down with time. But if we go to the financials, and I'm going to bring up the target platform again because we'll be able to summarize things much quicker in there. If we go to the materials tab and bring it up again here. So here we can see, I'm just going to bring up Flight Centre up here. And so if we go to segments, one of the things that we can see on the right-hand side is we can see Flight Centres in this very light shade of blue. You can see um, the the corporate side of Flight Centres. So this shows you that over time, not only is the corporate side, even through COVID, more sustainable, it's always been kind of consistent, but it's also growing, which is really interesting. So more and more corporates are traveling with Flight Centre, which is great to see. That's through acquisitions as well as organic growth. And you can see just how hard the more leisure side, just like you and I booking our flights to Bali, for example, that is really crushed. It still hasn't come back to that level that it was at previously. You can see where they make most of their money, still Australia and New Zealand dominate, but not always the case. If we go to shareholding, the company is run by a guy called Graham Turner or Screw Turner. Um, the business does have a pretty well-credentialed management team, and they are aligned. And when you own 7.5% of the company, that's pretty big. You do have a lot of financial incentives to make it work. If we go to financials down the bottom here, we look at the income statement, and I'll get rid of the year-on-year growth. But we can see the company's been severely damaged by COVID, hasn't quite recovered. If we go to the financial analysis tab, and if we go down the bottom here, we can see the return on capital. Remember how I said how vital this is? It's been negative for quite a while, but even prior to that, it wasn't hugely positive either. It was pretty good, but it wasn't, as high as some of the like the Pilbara, sorry, of today. But it's definitely one of those things where it's just in a more competitive industry, it tends to be a little bit more transactional. One of the slides from the recent presentation actually shows that the business Flight Centre has actually acquired a lot of new customers since COVID, which is really interesting because you'd think there'd be a lot of loyalty with a business like Flight Centre, and not necessarily is the case. Um, I mean, I'm sure people are getting a good service, but at the end of the day, it's not like it's software or some sort of like mission critical thing that people need to keep coming back to. So I'm going to jump back into the main slides I have. Bring those up. There we go. And so I'm going to say for management, I actually think I'm going to give it a 5 out of 5 because I think management are actually very, very good. I think the company is extremely well run. It's just a hard business to grow when it's so competitive and the industry is shifting so fast. In terms of a business you can understand, I think most people can understand the business. We just talked about the digital version of it there. It's not that hard to find out what the corporate side is doing. We can find out, you can just go down and experience a Flight Centre to make sure it's what you're thinking is what the business is. In terms of defensive business models, we saw that it was crushed during COVID, and that's they might say that that's once in a 100-year pandemic. The reality is a lot of software companies that are typically really defensive still made money during COVID, and so did healthcare companies, and so did utilities and these types of businesses. So compared to them, relatively speaking, it's not a defensive business model. I'd say it's quite cyclical. So I will give it probably a 3 out of 10. For growing sales and opportunity, I think its corporate side is growing, as we saw, and that's a huge opportunity for it. But the state of flux with competition and commissions and these types of things mean it's got a good sales opportunity, but it's probably just not as strong as, say, like Pilbara right now. And I'm going for like 5 to 10 year opportunity, to be honest, not like a 1 to 2 year. Strong profit and cash flow. Cash flows have come back a bit in recent times. If we bring those up here and we go to comprehensive income statement. I always use that term to search through companies. So you can see revenue has grown a lot since COVID and started to bounce back. Still not what it was previously. We can see it's returned to profitability, but it's just not as profitable as some businesses would be. We can see if we go to the cash flow statement, we can see it's brought in $156 million of cash. It's put a lot out because it's made a few acquisitions. Adjusting for that acquisition, it would be cash flow positive, but not in a huge way. Still quite cash flow positive, but not in a huge way. So I'll give it out of 10. I'll give it a 6 because it's still, well, maybe it's too generous, maybe a 5 because profits are still on their way back. In a normal market environment, I expect it to be quite profitable because it's actually quite a good business. So maybe a 6 is more reasonable. In terms of valuation, once again, we're not doing a full valuation, but I'm just going to quickly show you something that happens. And if we just get the share price over a long time, now what actually happens to a lot of these businesses, and this was very evident with, say, Webjet during this time, during the COVID period, is even though the share price has fallen and it's actually kind of come back in recent times. Um, One of the things that shareholders need to understand is that when a company falls like that, and then it has to do a capital raising down here to sell more shares, to get cash in the business to keep it afloat, what it actually means is even though the share price has fallen, it may actually still be the same size in terms of market capitalization. And the reason why that happens is that you've just got more shares outstanding. You've got a lot more shares that are now available. They're just not priced as highly. So you've still got the same market cap, but not as much in terms of you know the share price. So we could probably see that if we look at the weighted average number of shares. I'll see if I can get this up in a chart for us really quickly. something like this. That's not what I want. That's not a label. Okay, I might actually start again with this. I'll take that, pop it up the top here, get rid of that, go like this, go insert chart, go customize, chart style, series. Let's go. This shouldn't be like this. Sorry guys, I'll just get this up for us 1 second. Horizontal. Where are we? Set up. There we go. Stacking aggregate. No. What am I doing? Here we go. So here we go. We can see shares outstanding. We can see this. We can see the shares outstanding have absolutely ballooned. So during COVID, when I had to do like an emergency capital raising, we can see the number of shares that have been available in the company nearly doubled. When in fact they more than doubled, and that basically means that your share price has to be halved in order for it to keep the same market cap. So when you look at the size of Flight Centre, you might be thinking, well, the share price is still really low. Why can't it come back? And the reason is because people were diluted. They had to do a lot of capital raising and issue more shares to keep the business afloat. So that's one thing to keep in mind. So is it at a reasonable price? It's probably at a fair price, to be honest, just based on some very simple metrics. So I'm just going to give it a 3. There's no necessary override here. I'm not going to break the checklist for that. But so far, we can see we've got Flight Centre, we've got Pilbara, and now I'm just going to quickly do Qantas. Many of you will know that Qantas is Australia's kind of national carrier. It has absolutely been a basket case in recent times with poor board oversight. The company's board of directors, including the chair, the CEO, everything has been across the news recently, from price gouging to artificial pricing to you name it. There's been a fair bit of uncertainty at the government level as well in terms of their support, whether they should or shouldn't have supported Qantas, and so on and so forth. If we go to the financial statement, we can see it's got some cash on the balance sheet. It's got some property, plant, and equipment, but you can also see it's got a lot of liabilities here, and that's only what we know about, right? There are other things that people might point out as well. If we go up to the income statement, you can see just how dramatic the recovery in the revenue has been for Qantas. Like, look at that, added $10 billion in 1 year, but we've seen a huge increase in the costs associated with it as well. This is not an easy business to run. Richard Branson, the founder of Virgin, once said that the easiest way to become a millionaire is to start with $1 billion and launch an airline. Um, so that's one of the things to keep in mind. Chris, yeah, your question about a high PE ratio, and for Flight Centre, that would be the case because, as I said before, the profits are now broken down across more of a share base. So you effectively have the same profit across a lower, increasing number of shares. And that basically means the per share value is lower. Okay, so we can see for the most part, the business has a lot of things like leasing costs, has things like fuel costs, depreciation. It is a price taker, even though it is the leading airline. It has to take the price that's offered from airports around the world. It has so much that it needs to do in order just to be in the game. It's got an aging fleet and these types of things. It owes customers money for certain things. And if we go into the cash flow statement, we can see cash flow positive this year. But at the end of the day, it's one of these businesses that is very tough to run consistently and profitably throughout the full market cycle. So, for the most part, is the opportunity growing? Well, the government did block some competition for Qantas, so that's a good thing for Qantas. Not so good for consumers. It's good for national security, I guess. But let's just give it a 5 because it's not exactly compelling. Is it a defensive business model? No. So I'll probably give it a 4. Is it a business you can understand? Yes, but it does get quite complicated when you think about leasing aircraft and these types of things. So I'll give it a 6. It's probably a 5. It's not as easy to understand as Flight Centre, but it's still pretty easy to understand. Is management aligned? No. In fact, I think it's got probably some of the worst management oversight in the country. So I'm going to give it a 0. And you can just Google the news and these types of things to figure out why that might be the case. Does it have strong profit and cash flow? Pretty strong profit at the moment. But if we look back through time, let's just have a quick look at profitability through time. And we can see this is for Qantas. We can see the earnings per share over time. We can see for a period there it was negative, then it swung to very positive in recent times. It was positive for a while, then negative very sharply, then nothing, then negative, then positive, but not very positive. So it's kind of up and down over its 10 to 15-year financial history just here. So for the most part, it's actually not that compelling whatsoever. So I'm going to give it a 3 in terms of strong profit and cash flow. It can pay dividends. Sometimes, like even Warren Buffett bought airlines leading into COVID, but it's not reliable in that sense. Is it a reasonable price? To be honest, it's such a low quality business that if you try and get a metric like a price earnings ratio or something like that, it's actually quite difficult to do. I would just say probably not at this level. Um, and where we go to, I could at this point, and this is where the important part of becoming an investor actually sets in, is that here we can look at um, the the checklist so far, and we can say, well, hey, Pilbara is doing really well. Flight Centre's a good business, sorry, good management, pretty reasonable business, does have potential. And we can say Qantas is actually a pretty ugly business, really hard to run, doesn't have great management. Um, but we can actually see the checklist is not that much, and we can use our initiative here to say, well, should we override this? Should we readjust? And in our models at Rask, what we actually do is we actually have criteria where the analyst can override, and then they would just use Command Option M on their keyboard, and they would put in their reason for doing an override, and it just makes the model more accurate when you look back on it in time. So I'm not going to do one right now, but I just put that in there so you know how to do it. And finally, let's have a quick look at BHP before we wrap up. So let's get out of Qantas. This is BHP's report here. We'll get out of this one for Flight Centre, and we will go back to BHP. Now, BHP is obviously a big Australian company. It's super well known throughout the world. I think it is the largest company in Australia by market capitalisation. I'm actually going to share with you the target strategy again to get a quick summary of financials. If we go back here, we go to the chart here. Actually just going to bring this up as the full stock price chart, and we can see it here. And we can see, um, where is it? Way up here. I'm going to go BHP. We want the Australian version, sorry. Click on this. And we can see down the side here the different components of revenue. So here we can see iron ore is about 46% of the business. We've got copper at 30%. They've recently bought Oz Minerals off the ASX. They did an acquisition. We can see coal is about 20%, and then there's some other things in there. Now, it's important to understand that underneath these different commodities groups, you actually have other things bundled in. So unless you're familiar with mining, you might not know that copper is often found near gold. And within BHP's business, even though it says the copper kind of unit within our business, it actually incorporates things like zinc and gold and these types of things. And in coal, you have metallurgical coal and thermal coal. In iron ore, it's just pure iron ore. But that's how they break up their business. There used to be petroleum assets and oil and gas from the United States in particular, but that was sold off to Woodside. So Woodside got the assets, and all the shareholders got shares in Woodside, as well as some cash for the sale. So that was what happened there. If we look down and we look at profitability through time, and remember, we're looking at in this instance, the purple line, if you can see that on the side of your screen here, we can see that it's consistently generated a high return on capital. So 19%, 28%, 22%, 10.6%, 12.3%. Now you might be like, well, that's quite volatile, 10% to 28%, it's a long range. The reality is this is a commodities producing business. So it is at the whim of commodity prices. However, it is much more diversified than, say, Fortescue Metals. Fortescue obviously is very dependent on China and iron ore in particular. Rio Tinto, also very dependent on both of those things, although it's got more copper and things like that these days. BHP is more diversified than most of the major miners throughout the world. And that diversification has actually lent itself to being more stable throughout a crisis, like a financial kind of like crisis or commodity crisis. So we can see revenue pretty consistent in terms of growth rate. It's just ticking higher. There were a couple of negative years, but for the most part, it rides the wave up and down. So let's have a quick look at the financial statements, and I'll bring that up here. Where are we? That one there. Okay, bring this back up. So let's have a quick look at the financials. I've actually exported these already. So we can go like this, and we can put that there, and we will do insert chart, and we can see financials over a longer period of time. Um, and we can see the revenue through time. There have been some acquisitions. We see the fall off here of iron ore prices in 2013, 2014. And we can see the just general resurgence of the business. This first spike here, this big lumpy part in the financials and the revenue here, was actually this, what we call this, the commodities super cycle in Australia, where China basically took off. China, for a 3-year period, I remember reading on Bill Gates's blog one day, Gates Notes, said that China used more concrete than the entire American economy did in 100 years. China did it in 3 years, and that just gives you a sense of the infrastructure um, that's been undertaken throughout China in terms of just building out national roads, buildings, hospitals, bullet trains, you name it. That's all been built out and supplied at the end of the day by a lot of Australian companies and companies around the world that dig iron ore up out of the ground to make steel, coal for energy, copper for networking and electricity, like all of these different things. BHP has basically been an engine room for that, alongside Rio Tinto, Vale, and so many other massive global mining companies. And that's why you see that there, and then you saw the subsequent fall off of commodity prices when the Chinese economy started to redirect its spending towards like more consumer type things like electric cars and not so much the roads, to consumer staples companies, online companies, technology companies. You can see that play out in the BHP share price as well. So we can basically see all of the financials there. I would say, for the most part, is it a growing sales opportunity? BHP, if it can compound at 5% per annum, it's still going to make a lot of money. The thing that you'll find if you dig into the dividends, which is how I would judge the growing opportunity for BHP, is that the dividends are consistent, but they're not as consistent as they were 5 or 10 years ago when it was in a commodity super cycle. So I'd give it out of 10, I'd give it a 5 in terms of its growth potential. Let's be honest, it's a massive company, so it's not gonna grow nearly as fast as, say, Pilbara is, which is pure play, but it's not nearly as risky. Is it a defensive business model? Absolutely it is, even though the profits swing up and down quite wildly from one year to the next. The thing about the business is that it has diversification across commodity groups. It's also a lowest cost producer, so that means that it can take, its capital, like its cash or its debt, and during the next, like I guess, bust in commodity prices. It can actually take its capital and invest in smaller, more fragile businesses, and just reinforce its moat and its competitive advantage. So I would say yes, I'll give it a maybe even 8 out of 10. It's been around for over 100 years. Business you can understand, yeah, it's pretty straightforward to understand how the business works. At the top line, you effectively have commodity prices. So it could be a commodity price for anything. You have the production that it produces out of the ground. That gives you revenue. Then you have the cost of mining, which is sometimes called all-in sustaining cost, or um, AISC, or cash cost, or different types of costs. And then you have expenses for the business, things like marketing, staff, etc. And you get to operating profit. And that's basically how you understand a mining company. Commodity prices for that year and the average selling price, how much they produce. That gives you revenue. They've got some mining costs, so that's like cost of sales in the financial statements. Then you've got expenses, then you get down to profit. And obviously from that, then you can calculate dividends and things. So it's actually quite an easy business to understand if you put in the time. It's probably as easy as Flight Centre. You just need to understand the mining process. Is management aligned? Yeah, well, Mike Henry and many of the other people that are in charge of business have been there a long time. I'll give it I'll give it a 3.5 if I'm being slightly generous. It's a strong profit and cash flow, absolutely. Not as strong as Pilbara right now in terms of absolute terms, but yes, it's probably stronger than Flight Centre, so I'll give it a 7.5. Is it a reasonable price? I haven't done a full look at the company's financials yet, to be honest with you, in terms of the valuation. Price earnings ratio of 11, dividend yield of 5.6. I'll be looking at that dividend to see if it's consistent, and it is, but it's just not consistent at the right price. I'd probably be happy to buy BHP for maybe a dividend of like 7%. If I could establish what is the consistent dividend for BHP, like a consistent through the cycle dividend, I'd probably want to pay about 6 or 7% dividend yield. get the franking credits, it's closer to a 10% yield, and I think that would be enough to compensate me for the risk. We're not there yet, so I'd probably just give it a 2 in terms of that. And so far, we've got through the 4, and I've gone 2 minutes overtime today, but we've got through 4 companies, and at the end of it all, we can say that based on this, the 2 most impressive companies out of this list are probably in order: Pilbara, then BHP, and then moving down to Flight Centre. I wouldn't, to be honest, as the type of investor I am, I don't like to invest in every company. I like to be very selective. I wouldn't even look at Qantas again, after doing something like this. The management's too low quality. The company's in a very difficult industry. Unless it invented some magical thing that no airliner seemed to invent around the world, I wouldn't look at it. I wouldn't bother owning it. Um, you know, Qantas's competition includes companies that are run by governments effectively. So how can you compete on price and quality against, companies that have basically just have an unlimited check to fund their business? So it's very difficult. Flight Centre is a good business. It's been through the woes. It's in a kind of dramatic shift in the way people consume and purchase travel. I think it will still be relevant. I'm not as negative as some analysts, but it's just I'd buy it at a price, but it'd have to be a very low valuation. It'd probably be a long-term investment. So it's not really the type of thing that I do, or it's a special situation. BHP, I could own if it was at the right price. It'd have to be. It's not there yet. Uh, Pilbara is a business that I think should be on people's watch list. If you invest in commodity prices, you probably already invest in it. If you own something like the ACDC ETF from GlobalX, you already own Pilbara because it's held inside that ETF, but it's a really interesting business. So that brings us to the first installment of Tiger Stocks. Don't forget, you can get a free account. You can claim your free account. If you fund it with a certain amount of money and do a certain number of things, you can actually get some free fractional shares put into your account and so on and so forth. You can find all of the information in the video. Thanks, Chris, for commenting today, mate. I really appreciate it. Next week on Thursday, we'll probably get a bit more notice next week on the upcoming live, but we'll be covering a few different companies. So what's on the calendar for next week? Next week, we've got Costco, Microsoft, Apple, and Tesla. I'm actually really excited for this because I recently repurchased my Costco membership, and I think I kind of forgot how magical of a place it is to go and do some shopping, even though it's not as cheap as you expect. It's good value. It's good quality products. It's a wonderful business, very different to the other 3 businesses we'll be talking about, which is Tesla, Microsoft, and Apple. Tesla's kind of like a massive version of Pilbara if you look at its financials. Like, you see Pilbara's financials taking off. Teslas have just taken off as well because they've reached production, and the Tesla cars are everywhere these days. So we'll be covering all those next week. In the third week, we've got NAB, WiseTech, Altium, and ARB. More of an Aussie stocks kind of favorite thing. I'll be enjoying looking at those companies. I think the companies get better as we go on, to be honest. And then finally, we'll be talking about Trade Desk, which is an online advertising platform. Amazon, which is actually a competitor of the Trade Desk, now that I think about it, and Google, which is a competitor of both of those. And finally, NVIDIA, which is the company that everyone wants to talk about. So we'll be running through all of these things again in the next couple of weeks. You can find all of the videos available on the Rask website, on the YouTube channel, sorry. If you go to, hopefully you've gone through and you've actually done this thing. I'll show you really quickly. Hopefully you've gone through and you've added it to your calendar, and you've followed the steps to add them all to your calendar, because if you do this, it actually does have all the information you need, and it puts something in your calendar to say, hey, these things are coming up in the next hour. Here's the link that you need to go and check out the live show for today. So we'll be back for 3 more weeks covering more companies by the end of it. And hopefully next week we'll have some prizes to give away to folks. So if you haven't already created your account, you can go in and you can fund it and you can get started with the Tiger platform. There you go. Don't forget to read all the terms and conditions available on the Tiger website. Financial services guide and all those types of things are available on the website as well. Learn more about it. I'm happy to do this. Thank you, Chris, and everyone that rocked up live today. If you're watching on replay, there'll be more next week. And I'm actually looking forward to it. It's been good looking at some companies in more depth than usual to give away for free. So let us know what you think. If you want to write, if you want to leave a comment after the fact to tell us if you want me to change some of the companies that are coming up. I'm really excited about these companies. But to be honest, I'd be happy to sub out NAB for another company. Well, I've looked at NVIDIA a lot lately, but if you want me to look at it, I'll do that. Definitely some really high quality businesses coming up, but we can sub a few out for sure. All right, bye for now. I guess I'll see you next week when I'm looking at you then. Have a wonderful week. Don't forget about the giveaway. You'll find all the details in the description below. Thanks, Chris. Thank you, everyone, who tuned in.